Let's talk about the fast-growing and sexy industry of Medicare. Said no one ever. In this video, I do want to talk about Clover Health that is in the Medicare industry and was the monthly Patreon pick for me to analyze as a stock. So let's jump into what the company is all about, its future prospects, as well as what I think the fair value of the company should be. Clover Health is in the industry of Medicare Advantage plans, and they also offer a technology platform known as Clover Assistant, which essentially allows physicians to have more data on their patients, as well as have recommendations based on all of that data to lower their overall costs and provide value. If you're not familiar with Medicare, once you reach a certain age, the government helps out with healthcare coverage, but doesn't give you everything. Parts of Medicare, you get Part A, which is hospital insurance, and then medical insurance. And then you don't get anything else unless you go into a Medicare Advantage plan. So that's something like Clover Health, which offers a bundled version where you get all the aspects of normal health coverage, as well as basically the ability to get certain drugs covered, and then also things like vision, hearing, and dental services. So Medicare Advantage seems like the way to bundle everything, and it can actually be cheaper and give you more coverage than just original Medicare. And in order to offer Medicare Advantage plans, it has to be a Medicare approved private company that has to follow a set of rules by Medicare itself. So when it comes to Clover Health, they get money when people sign up for their Medicare Advantage plans, and they get paid from the Centers for Medicare and Medicaid Services. They're getting that sweet, sweet government money. I can now imagine everyone's eyes glazing over as they watch this video. Why is Clover Health all over Wall Street Bets? Why is it this stock that gets a lot of coverage? Well, it's one word: growth. As an industry, Medicare Advantage enrollment is supposed to be growing at 7 to 9% annually through 2023. And the total addressable market by the end of 2023 is supposed to be around $360 billion. That's a pretty big pie for these companies to go after. And there's big players already in this Medicare Advantage industry. So United, Humana, Aetna. I mean, there's lots of different companies that already have their hands in the cookie jar, but Clover Health is an innovative company that's trying to kind of wedge their way in and steal market share. While the industry has been growing around 7 to 9% per year, Clover Health is a different story. It's been growing much faster. So 2018 to 2019, 62% growth, 52% from 2019 to 2020. And if we look at the guidance for full year 2021, it was around $1.5 billion. So that's another extremely high growth year when it comes to revenue. When I originally did this research, Clover Health was trading around $7.86. It's closer to $7 now. But this stock has had an interesting history of even just becoming public, and then they've kind of been shrouded in this whole world of memes, as well as the whole SPAC bubble. When this company went public, they went public via SPAC with Chamath. But it's definitely been a bumpy ride with a lot of volatility because there was a short seller report that came out basically calling them out as a shady company that was under investigation from the Department of Justice for things like coding reimbursement, shady sales tactics, kickbacks, you name it. But at the same time, this company has had a pretty big short interest. So once in a while, it'll get targeted from Wall Street Bets, and it gets a nice little short-term pump. As of this video, it's trading at $7.14 or around a $3 billion market cap. You can see that 52-week range. I mean, we're talking $6 all the way to $29 before falling all the way back down to the 7 level. So if you love drama, you'll love this stock because there's been a lot of drama. But let's take a look at the financials to see kind of what they're telling us. First number that jumps off the page for me is the revenue. 172 million to 412 million. And you can see why people over at Wall Street Bets are getting excited. That's insane revenue growth. And a big part of that is this direct contracting revenue, which is a new source for the company. When you look at the losses, though, this is when I'm scratching my head a little bit because we're going from $23 million in income from operations to them actually losing money from operating. So that's a little bit concerning. So what's going on here? What is this $458,000 of net medical claims insured? And why is that higher than the revenues actually collected? They have something known as medical cost ratio in this industry. Take the cost of medical claims divided by the revenue, meaning that their costs were higher than the premium collected. So in the industry of insurance, you want to have that lower than 100%. The company does have its reasoning behind why that number is higher, and they're basically saying one-time effects from COVID, and if you strip that out, it'd be 97%. So 97 versus the prior year's 97.5, some improvement, but those margins are still very thin. And when I look at the balance sheet, they do have a ton of cash, right? $600 230 million. But if they have quarters where they're burning up $200-300 million in cash, that's obviously not a great long-term model. Either they'd have to borrow more debt or raise more capital in some way. I'm not saying those types of quarters are going to continue, but it's not great to see the whole negative gross profits. With that being said, though, it's also not entirely expected for them to be super profitable because of that growth that we were talking about. Chamath himself basically said they wouldn't reach profitability until 2023, and that's when you factor in that some costs scale very well. When your fixed costs stay relatively constant as your revenue grows, at a certain point when you start to turn a profit, and they just haven't reached that level yet. Now, I know there's some growth investors out there that hate the word profit. For me personally, sooner the better. When it comes to valuation, I think we can look at a competitor like Humana to see their price to sales ratio and compare that versus Clover Health and their growth rates. So Humana trades at around a 0.7 price to sales ratio, whereas Clover Health has historically traded around 3, which I think is reasonable because based on the growth rates for both companies, Humana is more around that industry standard, whereas Clover is growing 4 to 5 times faster than that. So looking at that 3 price to sales ratio and multiplying that by the trailing 12 months revenue, that would be fair value of around $6.30. Now, if you look at a 3 price to sales multiple for the end of 2021 revenues based on the guidance, that'd be around $10.52. But it's tough for me to say that we can still use that 3 price to sales multiple, only because I don't know what 2022's revenues are projected to be. If we look at the stock price of this company, at 28, it was probably overvalued on the short term. At 7, it's much closer to something that's reasonable when you use a reasonable price to sales ratio based on their growth rates. When it comes to risks and opportunities, I think the biggest risk is that all of their money, or most of it, is tied to the government. So if that investigation from the Department of Justice comes back and somehow disqualifies the company from offering those Medicare Advantage plans, well, this company is pretty much screwed. On the opportunity side, I would say the fact that they're stealing market share and growing faster than the industry must mean that the Clover Assistant technology is doing something better than their competitors. So with a total addressable market of $360 billion by 2023, if they can increase their market share of the Medicare Advantage plan, this company still has a lot of room to grow. The second opportunity I see is if they get into plans that aren't Medicare Advantage plans. They offer this software and it can be used for normal healthcare coverage. Well, now they've opened a new stream of revenue, and then they could also even compete with companies like Teladoc. If it's truly software that tracks and manages patient data, they could offer a variety of things outside of just making money from premiums that they're collecting from the insurance. With all that being said, I'm not personally adding into this stock. I think it's an interesting company. It is growing fast, provides a lot of volatility, so I may trade around it in my options portfolio. Don't love seeing that MCR ratio so high, and I would want to see more history of stabilizing that number or lowering it, because if the company scales and it still has a really high MCR number, that just means they're bringing in more revenue, but with that extra revenue, they're actually losing more money. But for a swing trade, hey, who knows? This thing may short squeeze. It's just really hard to time that, and I don't try to invest based on possible short squeezes. That's just not my style. If you guys did enjoy this video, make sure to give it a like, as well as consider subscribing to Main Street Wolf, where we talk investing, options, anything to do with money. Thanks guys for watching, and have a great day.